Hello, everybody, and welcome back to our next episode of Frankly Finance. So I'm Gemma Mitchell, and we have the wonderful Lexi Smith over here. So this week we're going to be talking about misconceptions around financial concepts and just really different kind of financial myths and misconceptions, which a lot of the inspiration of this came from different Facebook groups and communities and looking at the conversations that people were having in there, the questions that they were asking, and then the responses from the community, answering those with really just passing on their also misguided information, which is a little bit scary, but it's just so wonderful to see that people are in collaborative, communities and trying to improve their finances. But yeah, so that was the inspiration for this week's topic. So I'll hand it over to Lexi.
I think you made a really good point there about people talking about personal finance in Facebook groups, which to some extent I definitely encourage, because I think there needs to be more communication about personal finance. But I just want everyone to be mindful of where they get their information from and not to rely on, a bit like, parenting advice, like being medical advice. You don't go into a Facebook group and rely on what you're told there as to how to treat your child. You take them to a doctor.
But there's so many benefits of people being in those communities because the confidence that they have, I notice a lot of them post anonymously, which is such a great feature, but people don't know what they don't know. So they don't even know the questions to ask to better their financial situation. So just, taking a backseat and reading through those. But I think it's very, very important that you see an answer and you think, okay, well, that's something that I didn't know. That's really interesting. I'm now going to find out more information about that myself. Don't take it as a hard and fast, this is exactly the information that's accurate and what I need to know and that applies to your situation.
And it can be quite off-putting sometimes. Like I even remember seeing something just yesterday whereby someone was asking about financial advice, and you and I know firsthand how important, how powerful, how valuable financial advice can be in the right situation for the right person. But someone basically wrote a comment that really didn't shine a nice light on the industry, and it wasn't called for in this instance. And it's just, reading something like that might actually put someone off financial advice for their entire life. They may then go and talk to their friends and family to say, don't go and see an advisor, or only see an advisor if their net worth is 10 times what yours is. Like, there's some really bizarre comments that get thrown around.
So let's elaborate on that, because I think it's a really, really important thing. And obviously you and I particularly got quite annoyed with that. But okay, so for context for the people watching, what it was, and I hear it all the time, it's not from this one person, I hear it so often, I read it, I see people commenting stuff like this, and it just annoys me so bad. Anyway, because I'm a very pro financial advice, and that can be at very different mediums. Financial advice can come in the traditional model. It can come in, a digital robo form. It can come in a money coaching stepping stone. There's so many different forms of advice. But what this person's comment was, it was a question around finding a financial advisor and if it would be worth seeing one. And this person had written, if I was going to see an advisor, I would make them prove that they had 10 times my wealth and explain to me how they got that. And my whole thing with that is, as Lexi, you agreed, that there's so many scales and areas of financial advice. It might be Centrelink. I don't have to be on Centrelink to be a strategic advisor to give Centrelink advice. I'm not going to prove my net worth to you. You're seeing me as a client. We have a professional relationship. You're not seeing my finances. And you wouldn't ask a doctor to prove that they had cancer before allowing them to treat your cancer, because you know that they're professionally trained to be able to do this. And my other thing was, when I was like just furious, until I calmed down and was like, yeah, this is something that people do think that they are entitled to, but it is a professional relationship. But yeah, my other thing was, it might not apply to you how they created their wealth or be anything like that. But good luck finding an advisor that, if you said, if I had a customer sit in front of me and said that to me, I would be like, you are not the client that I want to help. Off you go, and good luck finding somebody that does want to help you. So then they've just alienated like majority. It's already hard to find advice and find advisors that you get along with and work with, and that's just going to alienate anymore. But I use it all the time. I use the doctor analogy. You are not going to ask to see a doctor's medical history before you let them treat you. So yeah. Anyway, I got very fired up about that one.
The two things that spring to mind for me, and the more that I also thought about it, the more frustrated I became with the comment. One is that, let's assume someone's net worth is $1 million or $2 million. 10 times that is $10 to $20 million net worth. If a financial advisor has a net worth of $10 to $20 million, chances are they're not going to be working as a financial advisor.
Actually, I didn't even think of that, but I'd be like, I love financial advice, but I'd probably be doing it somewhere else or on a different, that's really good.
Exactly. Like, they may be qualified to be an advisor, but they're not going to be working a 9 to 5 as an advisor potentially. I'm not saying that there are no financial advisors out there with a net worth of 10 to 20 million, but that was just my first thought. The other thought that I had was reflecting on my own journey through personal finance. And in my early days, say the first 2-3 years of being an advisor, I have fresh, up-to-date knowledge from all of the study that I have done. So I'm very up to date with all of the different strategies. Yes, I would lack some skills and knowledge that a more senior advisor would have had at that point that has, 10, 20 years experience. But why would my personal net worth, when I've maybe just, relatively fresh out of university, getting married, buying a house, having kids, potentially, things that aren't going to necessarily increase my net worth immediately, why would that then mean that I am not able to understand and apply various different financial planning strategies to a client who has a net worth of 10 times what I had? So yeah, and there's lots of different ways to look at these things, but I think that comment really fired you and I up.
It happens all the time. So we were not calling out this particular comment. It's just a misconception in the industry, and we see it so often. And Kim's actually put in the chat, which is such a good point. You can do your due diligence on this being a great advisor by looking at reviews, their experience, their education, making sure they're on the register. There are so many things that you do that has nothing to do with asking somebody to provide their personal details. And what if they made all their money on crypto and then next week it's like gone? I'd be like, oh no. But yeah, that's a great point. But yeah, so that got us fired up, which was exciting to talk about and shows how passionate we are about people getting financial advice and being in front of the right people. But let's jump on to some of the other ones that were in the group.
This was actually a poll that I put on Instagram stories a long time ago that really got a lot of engagement, and it was around the tax on a second job. So there is a misconception in Australia that if you are working and you have a full-time job, for example, if you go out and get another job, a side hustle, a part-time job, a casual job, whatever that is, that second job, that is taxed at 50%. That is a misconception. It is false. That is not the way that it works. So if you have 1 or 2 jobs, it is taxed as if it is one job. The misconception ties into the tiered system that we have in Australia, that you have different tax brackets, and also about the first $18,200 being the tax-free threshold. So whether you earn $100,000 in one job or $50,000 in one job and $50,000 in another job, at the end of the day, when you do your tax return, the tax that you will pay will be identical. So that was one thing that I wanted to clear up. Anything to add to that, Gemma?
It's so common. I hear it all the time that people don't want to start a side hustle, a business, or even, like rental income. They're like, I don't want to earn any more money in a second area because I don't want to pay the extra tax. But yeah, you're totally right. It's just because you can't claim the tax-free threshold on both jobs that it feels like it is more at the time. But at the end of the day, so you're going to get the difference back or whatever. It's all going to come out in the wash when you do your tax return. And earning is earning. It's like if it comes from an investment property or it comes from a share portfolio or work, it's all added on to your taxable income and you pay tax on that. There's not different tax rates. Generally, there's not different tax rates for how different money was earned. But I think
And
that
I've
holds a
actually
lot of people back doing.
had a few comments when we've busted that myth of people who said, I really wish I knew this 5-10 years ago, because that is why I didn't go out and get a second job. And if I had have had that second job, my life would look quite different right now, or I wouldn't have been under as much financial stress. So it's really important to understand the landscape and how it applies to you. The next couple of misconceptions also tie into that. So we've got the 50% misconception. This next one was actually one in a Facebook group that I saw just yesterday, and it was around someone saying that I am considering dropping a day at work so that I earn less income and pay more tax. And I can see the thought process behind it. I kind of identified that misconception, and it was correct. This is how they interpreted it, was that they were earning just over 120,000, say 140,000. And they thought if they got their taxable income down to 119,000, they would be in that lower tax bracket and therefore save a lot of tax. So the correct application of the tiered system in Australia is that if you earn, say, 140,000, the first $120,000 would be taxed the same way as if you only earn $120,000. It is only the amount above $120,000 that falls into that next tax bracket. So if you're earning 140, it's only the extra 20 that is taxed at a higher rate. How's that explanation, Gemma? Does that anything to add to that?
Yeah. I think that makes sense. And if people are really not sure, there's some great calculators online. So paycalculator.net or something, I think it is. You can play around with all of that and look at different scenarios for yourself to give you confidence on, oh, it's not making that much of a difference. Or yes, it makes a difference, but that's still extra money in my pocket that you can do a lot with.
I always use taxcalc.com.au. It's really, really simple to use. So taxcalc.com.au. And it has the different financial years. So if you're trying to work something out from a previous financial year, or if we're looking at the new financial year, you can, because tax rates, they do change. And you can tick if you've got a help debt. You can tick if your income that you put in includes super or excludes super. Yeah, very easy to use. And you can then do a couple of scenarios, like open up a blank Excel document and put like scenario 1, my scenario was this, enter that figure in, get the tax. If my scenario was this, what would that look like? So then you can make more informed and educated decisions around your income, your tax, the way you work, how you work, that kind of thing.
Yeah, you were saying about this came from somebody talking about dropping down hours. It made me think of another misconception that it's quite frustrating because it's looked in isolation, and it's that it's not worth usually the woman, the mother, going back to work because childcare is so expensive. So that's something that it's looked at so kind of tunnel vision that just at the woman's wage needs to be more than the childcare, but there's so much more that you can get from working. You know, they're not considering superannuation a lot of the time. They're not considering the employability, the job skills, the confidence that that person will gain from being back in the workforce, and that childcare is not one person's responsibility, their wage to offset. You know, it's a household expense, and they're enabling that other person to go back to work. But yeah, just from a social and education, a employability, a confidence, there's so much more that doesn't have a monetary value around it that is important that people go back to work if that fits in with their lifestyle, right? I'm not saying everyone needs to be a working mother, but I'm just saying when you're considering and you're doing the trade-off, whether I should be going back to work or whether the childcare costs, it doesn't make it worth it. There's so many more things there that you need to actually consider in making that decision that don't come down to your wage versus the childcare expense.
I often do sessions with mothers returning to work because they want to make an informed decision. So what we look at is scenario planning. So scenario A is you're just at home. Scenario B is you return 2 days, scenario C 3 days, and so on and so forth. And we look at the impact that has on tax, the impact that it has on childcare and on their overall family cash flow. There are some limited circumstances whereby there's more to consider. That's probably a discussion for another day. But I guess the takeaway of this is your situation is unique and you need to look at that and assess your different options, but not always make the decision from purely a financial point of view, and to kind of look outside the box as well. The next misconception still ties in with tax, because there are a lot of misconceptions about tax in Australia. And this actually comes from a post that I happened to see when I was mindlessly scrolling yesterday. It popped up and someone was saying, it's a new financial year, I'm being taxed, but I haven't earned $18,200 yet. Why is this happening? I thought the first X amount was tax-free. And so everyone actually contributed to that discussion, and the majority of the answers were correct to say that it is not worked out like that. It's worked out based on if whatever you earned that week or that fortnight, if you continued to earn that every single week or fortnight for the rest of the year, what tax would be applicable in that scenario. So to clear that one up as well.
Yeah, because it's really hard for an employer to look at, oh, well, what tax are we supposed to take out? So what they do is they pretend that, right, that income was going to be exactly what you would earn. And that's why you do a tax return and it gets adjusted, because you never know. And we can't, you can't go, oh, well, you had a big week, we're going to tax you the same every time, because it's going to be adjusted. So this affects people that are casual and have irregular income, but also if if you get a bonus, for example, and it's paid your pay, it's not going to impact future times. You're not going to pay a higher tax rate on all your pays. It's going to work out well. Just assume that you're earning that every fortnight or every month.
The next misconception is about credit cards. Without me even telling you, Gemma, what do you think this misconception is?
Oh, there's so many. Possibly that you need one to have good credit.
Bingo!
Also the 55 free days. So I used to work in a bank and people would come in and go, but I get 55 free days and I bought that and that's not 55 days. And I'm like, it's up to 55 days depending on where you are in the cycle of your statement. If you bought it on the bought that item on day one that your brand new statement refreshed that period, then you'd have 30 days plus your 25 to repay it. That's your 50. If you buy it on the day they're about to calculate your statement, you have till the due date, maybe 20 odd days. So that was another one that I spent a lot of my time explaining to people.
And that you need to actually pay off your balance to have access to those interest-free days.
Yeah, and in full, if you do like a credit card advance and things. So if you've accidentally taken cash out of it or transferred from it and it's seen as a credit card advance, like a cash advance, interest-free periods are gone and you're paying like full interest rate. But yeah, credit cards is a good one. So what did I get right? I forgot.
That it was that it's needed to build your credit score, which it's different overseas, but in Australia that's not the case. We have quite a few other ones for different areas, so being mindful of time, I'll jump ahead. But if anyone wants us to talk more about credit cards in future,
we could probably do a whole session on credit cards, because most of the information online is from overseas. So like credit card points hacking and all of that, and it doesn't really apply here, and it works against you. So we could probably do a whole session of one of these weeks just on credit cards.
The next is a misunderstanding. So I guess you could argue misconception on debt consolidation. What do you think that might be, Gemma? This is like a game show now.
It is. I hope I'm getting points. Consolidating debt. Oh, there's so many again.
So if I have lots of debts and I think, oh, I'm going to consolidate, this is a great idea, my repayments are going to be lower. What is the thing that I'm failing to take into account, possibly, if I'm consolidating into my mortgage, maybe?
Oh, yeah. Thank you for more hints until I got this. The issue is the time frame. So you might have lots of smaller debts that are 1 year of high interest or 5 years of high interest. And yes, it's really attractive to consolidate on a much lower interest rate for your home loan. But chances are the bank's automatically going to set that up on a 20, 30-year time frame. So you've now amalgamated it with this debt and the interest is much longer. So when I used to do strategies about debt consolidation for people, one, I would stress that it's not going to fix the behavior. So debt consolidation rarely fixes the problem, because if people haven't changed the behaviors that got them in a lot of debt, they are potentially going to keep doing that. But also, they're making repayments over a much longer time, so they're paying more interest.
So in the scenario where you've got like a $5,000 credit card and a 20% interest rate, and you've got a home loan with a 5% interest rate, you think, well, that's the way to go. I want to be paying 5%, not 20%. But as you say, when you actually sit down and you do the calculations, you end up paying a lot more interest, unless you add extra repayments to be able to pay that portion of your debt off sooner.
And that's what I used to do if I recommended it. I'd either say, talk to the bank about, yes, doing it as a home loan, but a separate loan, and focus that you are going to pay that off quicker, or do the calculation yourself if you've got good discipline, and then go, right, to be able to pay this off, I need to pay X amount so that I know in a year or 5 years, we're no longer still paying for that debt 30 years later.
The next misconception, investing equals gambling.
Oh, yeah, that's one that is frustrating to hear, but I totally understand how people feel like that. And that's got a lot to do with their money mindset and how they grew up, you know, all that stuff that we kind of talked about in previous weeks. So their relationship with money, how their parents managed money. And it is really scary. The first time that you're kind of considering investing, and if you don't know too much about it, it can be really scary. It can feel like a gamble knowing where to invest. But that's kind of like buying a house, right? You're taking a gamble that that street in that particular suburb and that house is going to grow in value. That's a massive gamble as well. But what I say to people that are worried about investing, getting started, is chances are, if you're working in Australia, you're already an investor. You have superannuation. So start learning about that and looking into that. But yeah, that's a big one. What do you do around that?
Well, I was just going to say that's actually one of the other misconceptions, that property is always a safe investment. And I know people personally who have, I guess you could say, gotten a little bit unlucky as well and bought homes in mining towns and now owe more than what the property is worth. So there's always going to be risks, but it doesn't mean that investing is the same as gambling. The next misconception is that salary sacrifice is always beneficial. So tell me, when wouldn't salary sacrifice potentially be beneficial?
So there is definitely a line, because it depends on your taxable income. So if you earn under a certain amount, and I can't recall it, what is it like? Yeah, we can work it out for you and on those calculations. But so salary sacrifice is to reduce your taxable income. So if you're already on a low taxable income, it might not actually be beneficial to put more into super as salary sacrifice. It might be better for you to be doing it, if you still want to build your super, you could be doing it as an after-tax contribution because you've paid less elsewhere. But the super system doesn't look at your personal situation in a lot of respects. So super just has a flat tax rate of 15%. But potentially, yeah, you could be better off doing it a different way. So getting advice around your contributions is really important. You can't just go, oh, well, my mate is doing salary sacrifice, so I should do it too. You need to compare salaries and the other things that you've got going on to see if that's the most effective way for you to contribute to super, because it might be doing it after tax.
Because I have seen that people contribute to super thinking, I'm doing this to reduce my tax. And then when we actually do the numbers, it actually results in an increase in tax. And that's going to be unusual. It's going to be not something that's common, but you should look at the numbers before you just go and start something like contributing to super.
Yeah, but either way, contribute to super, absolutely. But there's different ways that you can do it. So you can be strategic on it. And it might change, you know, one year you might do it this way, and then the next year you might do it this way because your salary is changing or the government, you know, rules and regulations are changing.
Different topic again in relation to insurance. So I've seen this comment before saying, I don't need income protection insurance. What I'm going to do is self-insure, which is a legitimate thing, self-insurance. But when you take into account setting aside, let's say your premiums are $2,000 a year, okay, I'll set aside $2,000. And so if I ever don't have to work, I've got that buffer sitting there. That is my income protection insurance. But as you well know, Gemma, if you can't work until forever, you can't work again. So you might be 30 years old, retirement might be, you know, in your 60s. You've got 30 plus years where you don't have an income. That's going to be millions of dollars if you add up your earning potential over that time. Even if you invested that money, if you're just setting aside $2,000 a year, that's not going to translate to that same sum.
I 100% agree. I think you can only self-insure if you've got the capital, like you've got a property you would sell, or you've got an investment portfolio that you could live off. I don't think you can self-insure by saving the premiums because the figures just don't work. But the other misconception around insurance is a lot of people are like, oh, well, I don't have a family, I don't have kids, so I don't need insurance. But I'm big on, so maybe you don't need life insurance. Maybe you don't. Maybe you've got debt, but the assets would be sold. So maybe you don't need life insurance. But in that example, if you could never work again, regardless if you've got a family or not, chances are that you're still going to have, if you don't pass away, you're going to have expenses. You're going to have housing expenses, particularly medical. Like my ex-husband finished work at 38 and had really good insurance, so he was able to. And he's not sitting at home doing nothing. He's going surfing twice a day, going on surf trips, going on camp trips, all stuff like living his best life just with his disability. His life didn't stop and his expenses didn't stop. So having an income protection or a disability cover, regardless if you've got a family or not, you are still going to have expenses that need to be met. And what's Centrelink? Like 21,000 or something. Like you just can't rely on it.
Yeah. In the interest of time, we'll do one more. This is quite broad though, and you will love this topic because I know how much you do love super, but it's misunderstandings about super. And I think the two that I often see coming back to the Facebook group thing is that it's not really your money and that the government uses it. So yes, a lot of people think that the government have access, have control, use that money, and then when you need it, they kind of give it back to you. But that's not how it works, is it?
No, so the government sets rules around it, like what age you can access it, the tax and stuff. But the trustee of the super fund is responsible for controlling that money for you. And yeah, so it's absolutely your money. The other thing would be, I always hear people go, oh, I hate super because someone I know lost all their money in super. And I'm like, wait, super's not actually an investment itself, okay? It's a tax structure. Yes, you can invest in it, but think of it like this bubble. It's a tax structure, it's a trust, it's something designed, a vehicle designed for you for your retirement. But what you actually invest in it could be as safe as a bank. It could be artwork, cars, property. Like super itself can't lose money. It's how you're invested underneath.
That's a very important one and a very, very big misconception. And people as well tying into that, thinking that to have control over how the money is invested, that they need a self-managed super fund. So you still have control even if you are in a retail super fund or an industry.
Like even the industry funds now are offering direct shares. Like you can go in, you can have so much control over it. You know, it seems like every year there's less and less reasons why you would need a self-managed super fund. It's kind of these days more around estate planning, you have a bit more control over there. And maybe you were going to have like a property in there, like a residential or a commercial property, but there is so much you can control and options that you have in a retail industry type of fund these days. So you've just got to take an interest in it and learn what you can and can't do and not be scared of it.
Perfect timing, 11:30. So same time, same place next week.
I will see you then, hopefully without the cough.
And without the children.
Yes, hopefully. Okay.
Okay,
bye.
bye.